In September 2008, while the world watched Lehman Brothers collapse, a much smaller drama was unfolding in Dublin that would ultimately cost taxpayers far more, relative to the size of their economy, than almost any banking failure in modern history. Anglo Irish Bank, once celebrated as the fastest-growing bank in Europe, was quietly dying, and the people running it knew it long before anyone else did. Anglo Irish Bank wasn't always a house of cards. Founded in the 1960s, it spent decades as a relatively conservative lender. But starting in the late 1990s and accelerating through the 2000s, Anglo transformed itself into something else entirely: a property lending machine. Ireland was in the middle of the Celtic Tiger boom, and Anglo decided to go all in on commercial real estate and development loans. While other Irish banks diversified, Anglo concentrated. By the mid-2000s, the bank's loan book was overwhelmingly tied to property developers, many of whom were borrowing tens or even hundreds of millions of euros for speculative projects across Ireland, the UK, and beyond. The bank's CEO, Sean Fitzpatrick, became something of a celebrity in Irish business circles. Anglo's share price soared. Profits looked spectacular year after year. The bank was praised in financial press as a lean, efficient alternative to the bloated traditional banks. Investors loved it. Analysts recommended it. For a while, it seemed like Anglo had cracked a code that nobody else had figured out. But the code wasn't innovation. It was concentration risk dialed up to an extreme, combined with a culture that increasingly blurred the line between aggressive lending and reckless lending. By 2007, cracks were already forming in global credit markets, and property prices in Ireland, which had risen at an almost unbelievable pace for over a decade, began to wobble. For a bank like Anglo, whose entire loan portfolio was essentially a bet on Irish and UK property values continuing to rise, this was an existential threat. And yet, publicly, the bank continued to project confidence. Internally, the picture was very different. This is where the story moves from bad business decisions into outright fraud. One of the most notorious schemes involved a series of transactions known as the circular transactions with Irish Life and Permanent, another financial institution. In essence, around the end of Anglo's financial year, Anglo would transfer billions of euros to Irish Life and Permanent, which would then deposit that same money back into Anglo. On paper, this made it look like Anglo had billions in customer deposits that simply did not represent real independent funding. It was money going in a circle, designed purely to make Anglo's balance sheet look healthier than it actually was at the exact moment regulators and auditors were checking. These transactions inflated Anglo's deposit base by billions of euros at critical reporting periods in 2008. At the same time, another scandal was unfolding involving the bank's own chairman. Sean Fitzpatrick had been borrowing enormous personal loans from Anglo for years, reportedly reaching well over 100 million euros at points, to fund his own personal share purchases and investments, including in Anglo's own stock. The problem wasn't just the size of these loans, it was how they were structured. Each year, just before the bank's annual accounts were finalized, Fitzpatrick would temporarily transfer these loans to another bank, Irish Nationwide Building Society, for a short period spanning the audit date. Then, once the accounts were signed off, the loans would move back to Anglo. This warehousing of director loans went on for roughly 8 years, meaning that Anglo's published accounts never reflected the true scale of lending to its own chairman, lending that, if disclosed, would have raised serious red flags about governance and risk concentration at the very top of the bank. When Ireland's banking crisis hit in late September 2008, the Irish government made a decision that would define the country's financial future for over a decade. It issued a blanket guarantee covering the liabilities of Irish banks, including Anglo. At the time, the government appears to have believed Anglo was facing a temporary liquidity problem, a cash flow issue that could be bridged. What they didn't fully understand, partly because of the deception described above, was that Anglo wasn't just illiquid. It was insolvent. Its loan book was rotten, full of loans to developers whose projects were now worth a fraction of what they'd borrowed, if they were worth anything at all. By January 2009, the situation had become impossible to hide any longer. The Irish government nationalized Anglo Irish Bank entirely, taking full ownership and effectively turning what had been a private bank's bad debts into a direct liability of the Irish state. Sean Fitzpatrick resigned in disgrace once his hidden loans became public. What followed was years of forensic accounting that revealed the true scale of the damage. Anglo's losses, once fully recognized, came to roughly 34 billion euros. To put that in perspective, Ireland's entire economy at the time had a GDP of around 160 billion euros. A single bank had lost an amount equivalent to roughly a fifth of the country's annual economic output, almost entirely through bad property loans, accounting deception, and a culture of governance that allowed a small group of executives to operate with virtually no real oversight. The cost to Irish taxpayers was staggering. Government recapitalization of Anglo alone is estimated to have cost in the region of 29 to 30 billion euros. This was layered on top of bailouts for other Irish banks, ultimately contributing to Ireland needing an 85 billion euro bailout from the EU and IMF in late 2010. Ireland, a country that had been one of Europe's economic success stories just a few years earlier, was suddenly synonymous with austerity, emergency budgets, and a banking collapse so severe it threatened the country's sovereignty. The human cost was enormous and largely invisible in the headline numbers. Years of austerity measures followed: public sector pay cuts, reduced services, emigration of young workers seeking opportunities abroad as Ireland's economy contracted sharply. Ordinary citizens who had nothing to do with Anglo's lending decisions found themselves paying, through taxes and reduced public services, for losses generated by a small circle of bankers and developers chasing yield in an overheated property market. Legally, the fallout took years to fully play out. Sean Fitzpatrick faced multiple trials related to the hidden loans and the Irish life and permanent transactions. Several executives were convicted in connection with the circular transaction scheme, including former finance director Willie McAteer and former Irish life and permanent executive John Bowe, who received prison sentences, among the first custodial sentences for white-collar banking crimes in Irish history. Fitzpatrick himself, after a lengthy and controversial legal process, including a collapsed trial, was ultimately acquitted of the most serious charges related to the loan concealment, a verdict that remains deeply controversial in Ireland to this day. Anglo Irish Bank itself ceased to exist as an independent entity. It was merged with another nationalized lender, Irish Nationwide, to form the Irish Bank Resolution Corporation, which existed solely to wind down the toxic assets over time, a process that took years and cost billions more. The Anglo Irish Bank collapse remains one of the starkest examples in modern history of how a relatively small institution, through a combination of reckless concentration risk, deliberate accounting manipulation, and a near-total failure of internal and external oversight, can inflict damage on an entire nation's economy that takes a generation to recover from. The bank's executives believed they were managing temporary problems with clever short-term fixes. In reality, they were burying a 34 billion euro hole that the Irish people would spend the next decade digging out of.